Joining us for day 3 of Property Topics Going Head to Head. It's powered by Nova Financial, and joining me all this week is Nova MD Paul Mahoney. And Paul and I wanted to create this week to show that robust debate is one of the healthiest ways to learn and grow, and that it's very important to take in a lot of different inputs, see the logic behind that person's opinion, and also actually look at the credentials of the person making the opinion, see if there's any agendas there, and then form your own view. And that really is the healthiest way to learn. And as I said at the beginning of the week, Paul, I will often actively seek out people that don't agree with me, because I want to test my opinion. And actually one of the things I do is actually look at House Price Crash, which is quite a notorious site, but you know, they have some very, very strong opinions and some very long and robust debates, and I learned so much just from seeing such an extremely different opinion to my own.
Yeah, I agree. Getting out of your comfort zone sometimes is a really good thing. Hearing other people's opinions, even if you completely disagree with them, you know, thinking about them and trying to understand how they've come to that opinion. Now, sometimes that's going to be very difficult, but yeah, a friendly debate like this is always a positive thing, I think.
Yeah, and certainly there's no need to take it personally if someone disagrees with you. It's not a personal thing if it's done in a professional manner. And, you know, people debating with you, you should welcome the fact that they are actually paying with their attention to your argument and coming back with counter arguments. It's actually that they're actually doing you a favour to help you learn. Absolutely.
And look, this is obviously the beauty of property tribes. You know, everybody gets a say. Everyone give their opinion on that say, and I'm sure there's going to be lots of opinions about these discussions.
Well, that's what we want. We want to fire up those differing of opinions. Now, we're going to talk today about North versus South. This is a very recurring topic on Property Tribes. Now, where I'm coming from is that I've been a landlord for 17 years. Most of our stock is in London and the South East, and holiday lets on the South Coast. We do have a couple of properties up north. One is a 2-bed flat in Chapel Allerton in Leeds, and the other is a 4-bed house in Manchester, in the outskirts, Ashton-under-Lyne. So I am going to be speaking again from personal experience here. And Paul, I am in favour of the South. And my reasoning behind this is it's where the wealth of the country is concentrated. It's far more highly developed up north. The density of housing is much higher, whereas up north you have got lots of brownfield sites, industrial areas where new apartments and so on can be built. And I've always found that the quality of my tenants in down south has been higher than the ones that we've had up north. Now, I'm just giving anecdotal evidence there from my own experience. So over the 17 years, the stock in London and the southeast, you know, it has performed better overall, and in terms of, you know, less voids, etc., less difficult tenants than the stock we have in the north. So what have you got to say to that?
All good points, and I understand you're coming from your own experience there. Look, I think, so predominantly my personal investments and through Nova, we are more focused on the north. Believe it or not, there is more to this country than south of Watford. But in saying that, we also like to have our cake and eat it. And what I mean by that is we try to focus on the most robust locations in the north. So I would agree with you that there are some areas in the north that wouldn't sort of tick our investment due diligence boxes. However, the UK has been through a pretty substantial shift over the past 5 or 6 years from what I've witnessed. And that is more of a shift toward places like Birmingham, Manchester, Liverpool in numerous different ways. That's, you know, foreign direct investment, not just going into London, but going into those cities, so overseas money coming in. More population growth going toward those cities rather than London. The transient population within the UK completely shifting on its head, from people coming from the north to London for the jobs and the higher wages, to wages not rising, cost of living rising, and therefore that shifting and people moving from London, the southeast, to the north for very similar wages and a much lower cost of living. And then also job growth and significant wage growth in all of those three cities I've just mentioned. Now, because of those things, that has meant that those three cities over that time frame has led the UK for property price growth, pretty much in that order, in various different ways in that order. Manchester, Birmingham, Liverpool, or different sort of 1s, 2s, and 3s over those years. So they perform very well, and it's nice to see that, because we started investing there 5 or 6 years ago, and back then it was much more difficult to convince people to look away from London. But all of that has come into and is still coming into fruition. So I think when you're focusing on major cities like that, in my view, as somebody, well, as a company, we spend a lot of time doing a lot of research and due diligence on the best possible locations and the best possible properties within those locations. And therefore, I suppose in some people's eyes, we almost look a bit like a one-trick pony, so far as for three-trick pony, focusing on those three cities. But that comes down to the fact that whenever we assess a new location, we struggle to find one that stacks up based upon things like population growth, strong tenant demand, a broad range of industries providing a broad range of employment. That's a key point, I think, because especially in the current market, when we're looking at risk of unemployment rising after the furlough scheme, if you're investing in a location that's driven by one industry or even one company, that's a very high risk. Whereas you look at Manchester, I think there's 95 of the FTSE 100 companies have a substantial office there now. That's very broad and diversified. So facilities, amenities, and infrastructure. We're ticking boxes so far as what people want and need what drives people to want and need to live in your property. If we have an abundance of those things, that gives us confidence in demand and reduces risk and makes the properties much more sustainable. So that's what makes us comfortable with those locations. Now, when we compare the likes of Birmingham, Manchester, Liverpool to London, for example, on a numbers comparison, there is no comparison. They are substantially better for rental income, net rental income, and you could argue potential for capital growth over the coming years. Coming from a financial planning background, a very common disclaimer is that past performance is no indication of future performance. And I'd say that's something that's probably quite relevant to the UK property market, because yes, London has every reason, in my view, to be as expensive as it is. Now, some people will disagree with me on that. There's a reason London's expensive, and that's because lots of people want to buy here. It's all about supply and demand. And that's what's driving those three cities I just mentioned as well. But in my view, there's a lot more potential to be had there based upon affordability. The average property price in Manchester is about 5 times the average income. The average property price in London is about 12 times the average income. So, half as affordable, if you like, as in Manchester. So that's why we like those cities. You've got higher rental yields in the right locations. You've got very low vacancy rates in those sort of city centre areas I just mentioned. And comparatively, you've got much more going into those cities than, for example, in London. There's lots going into London, but it's already very robust. So it's hard to make a big impact.
No, I agree with you, Paul. And I think, I am going to come your way a little bit on this one, because I think that COVID-19 lockdown has actually maybe amplified a lot of the trends that you spoke about, of people moving up north and big companies being up there, lots of infrastructure projects bringing work to local people up north. I think there is a shift in that direction. And also, only today we've heard that rents in London are actually in decline. Maybe because of post COVID-19, people thinking, actually, I don't want to live in a city anymore. I can work from home more. I'll take a slightly longer commute because I'm only going to be going into the office 2 days a week. So, it's such a fluid situation at the moment, post-COVID. And I think, we could have this conversation in 5 years' time. And, we might see that, things have changed very, very drastically from even where we are now. And one thing I will say, though, Paul, is, people, you do get newbie investors who, are seeking that holy grail of, capital growth combined with high net yield. They might be based down south. They go up, they see properties from up north that are, 60 to 100,000 with these wonderful headline yields, and they can be quite seductive to see those kind of things. But again, I always say, remember that the running costs of a £100,000 terraced house in outskirts of Manchester is that might achieve 450, 550 a month rent. Those running costs are similar to, a 2 or 3 bedroomed house in Guildford in Surrey, where I live, that might cost 400,000, but brings in £2,000 a month rent. So these are all things to consider. But I guess, when you're buying new build properties, that is what you advocate at Nova, you're not really going to have too many repairs and big capital replacement costs, maybe for the first 10, 15 years or so.
Yeah. And look, I agree with you on that point as well, with regards to seeking out the really cheap, potentially really high yielding properties in the north. You're right, there's lots of properties in the northwest, for example. You can buy them for 50, 60 grand, and on paper the yields might be 15%, but the vacancy rates are much higher, the maintenance is much higher, the quality of tenant is much lower. So the likelihood of actually getting that 15% it's probably not going to happen. Well, it's not going to happen. So you need to much more account for those things as well, in comparison to, for example, renting a city centre flat to a young professional, where you can almost be 100% confident they're going to pay you rent. And they'll probably look after the place because they'll value it if you tick all the right boxes. So there's a big difference. And I think sometimes people use a broad sweeping brush when talking about the north and the south. And sometimes people talk about London like it's the only place in the UK, and obviously we know it's not. But also can kind of throw everything into one basket. The average sort of price we've been looking at in the north has been around sort of 200 to 250,000 of late. And for that, we're talking high quality, central located properties that are giving, 5 to 7% yields. So that in our view is where you want to be in the current market, especially. I gave actually a client gave me this example the other day. We were talking about investing in central locations, and he said, well, what if everybody stops working in the city centre, or there's a big exodus out? And I said, well, that might happen in the short term, but there was going to be some sort of progression back toward working in central areas at some point, I would have thought. And I said also, based upon previous experiences, so if we look back to 2008, what happened in 2008 is there was lots of job loss, there was lots of redundancies and companies shutting down. And where it struggled the most was your smaller cities and towns. And quite often those people that lost their jobs, they had to flock to where the majority of jobs were, which was city centres. And there'll still be the majority of jobs in city centres, regardless of any sort of exodus. And he said to me, oh yeah, actually, I was living in Essex in 2008. I lost my job and I had to go to London. So the example tied in perfectly to what actually happened to him in 2008. But another good example, I think, is, and one I often use, is I look at the graduates working in our office in the city in London. They're on an average graduate wage. For them to save the deposit and have enough income to buy a property in London within the next 10 to 15, 20 years, it's almost unreachable. Whereas they could go to the Manchester city centre, buy a penthouse 2-bedroom apartment for 300 grand. and live it up in the most desirable location in that city. Whereas you can buy very, very little for that in London. So you can see why these young people are going to or staying in those areas more so than they have in the past.
Yeah, no, I think these are all very good points. So I would say probably that not all that glitters up north is gold, but there are some golden nugget properties to have up there, and it's a case of understanding how to research them, knowing the locations very well, etc., etc. And of course, it again, as we've said all along, it mitigates risk to have a variety of different locations, different property types. It's that age-old adage of not having all your eggs in one basket.
Yeah, exactly right.
Yeah, no, it's very interesting times. Okay, so we've got 2 more days to go of our property topics going head-to-head week. That's it for today's instalment. If you've been watching us on YouTube, please do hit the subscribe button, click the notifications and slam on those likes. We do appreciate it. And if you'd like to discuss this with the Property Tribes community, then please come across to propertytribes.com, and we welcome everybody's thoughts on this topic as to whether it's better to invest in the south or the north. But I think what Paul and I have teased out is actually it's not a case again of one size fits all, and it's good to have a mix.
Yeah.
Fantastic. Okay, well, we'll see Paul again tomorrow. Thanks for watching for today, and we'll say goodbye for now.